All right. Well, good afternoon and welcome everyone to today's presentation on life insurance planning opportunities post IRS Section 7702 change. My name is Andrew Casilius, Marketing Manager at U.S. Advisors Insurance Agency, and today I have with me my colleagues Rod Crandall and George Steele, and our very special guest, Brad Mills, Regional Vice President of Symetra, and his team, Matt Straub, internal wholesaler, and Doug Bowden from Symetra's Advanced Markets. And as always, to those of you who work with U.S. Advisors Insurance Agency, I want to extend a big thank you for your business and your partnership. And for those who have not worked with us, welcome, and I invite you to contact me or my colleague George Steele on your next life insurance, long-term care, or annuity case. And I guarantee you, you will not be disappointed, and you will also receive a complimentary insurance advisor's toolbox filled with resources, educational videos, fact finders, and everything you need to identify, position, and implement insurance strategies for your clients and prospects. We do have a lot to cover today, so we will leave Q&A session to the end of this presentation if the time permits. But you are certainly welcome to submit your questions via the chat box, and we'll try to capture them and get back to you with answers at the end of this presentation or over the next few days. Now, before I introduce Brad Mills from Symetra and his team, I'd like to have Rod Crandall, our Chief Integration Officer with U.S. Advisors, share a few of his comments and personal experience working with advisors and their clients, and the positive impact he's seen himself post 7702 change at what an exciting time this is to do some life insurance planning. Rod, take it away.
Thank you, Andrew. Yeah, I'll tell you, in my 20 years in business, I've not been as excited about a change or a product enhancement or a strategy enhancement as the changes that we're going to hear about today. You know, at the end of the day, if we can get our cost drag down for our clients, and to the extent that taxes go up, this creates like the perfect situation to be able to share these types of strategies. I'm sure you're very well aware that they're talking about raising taxes about 12 different ways, it appears. Corporate taxes, marginal tax rates, estate taxes, right? Capital gains taxes, the elimination of the step up, right? A cap on itemized deductions, and it goes on and on. While we don't know which of those will come to fruition or what that will mean, I think it's pretty fair to believe that taxes are moving up in the future. And again, if taxes move up and our cost of insurance moves down, then we have this wonderful, wonderful opportunity to really do some really special things. And what I would contend to you is that if you can't get excited about what you're going to hear today relative to the interesting things we can do for our clients, you might not be that excited around accumulation strategies in particular. Right, so please pay attention here today. As Andrew talked about, we're really in the business of helping you identify and position opportunities. So as you listen today to this wonderful material, I want you to be thinking about who are the clients that you need to have a conversation with. And then hopefully you'll pick up some good language for how to have that kind of conversation. Because what we find is that if you just ask people if they want to buy insurance and they want to pay a big premium, the answer is no, I don't, and no, thank you. And that's not what we're talking about here. We need to understand what our clients' goals are and really understand how we can use the unique asset class called life insurance. And so I'm personally looking forward to this a lot, to learn a little bit more about some of the strategies with 7702 outside of accumulation. And as Andrew indicated, we do have a very full day. So with that, without further ado, I want to go ahead and introduce Brad Mills. He's our regional VP at Symetra, and he has team members with him as well, both Brad and Doug that will, well, actually Matt and Doug, who will also be presenting. So with that, I want to turn the floor over to Brad. Brad, thank you very much for being here.
Thanks, Rod and Andrew. I appreciate it. And Team U.S. Advisors, we have a great relationship with you guys and appreciate you kicking us off here. So thank you. And to everyone on the call, definitely appreciate you taking your time out. We do have a lot of content to get through, and you know what? I'm so excited I can't even sit down about 7702. So anyway, we'll jump right in. Head into the agenda here. Like we're walking up to our first day of college and the university, and we actually made it to class instead of skipped, but we made it here. And we're going to talk about 7702 and really the impact that we've seen across a ton of case design work. As Rod mentioned, I have Doug Bowden, our Director of Advanced Markets, on the line with us, as well as my internal partner, Matt Straub. And we do a ton of case design work behind the scenes, also pound on underwriting to win cases. So if that's one thing you know from us, we'll work hard to win your business and your cases. But once we get into 7702, there's some things that we've seen throughout all this case design that are some implications of 7702 that really may not have been thought of when it came out. Of course, the minimum non-MEC, maximum funding scenario with income distribution is what everybody thought would happen. It'd be increased distribution. But let me start with saying really how 7702 came into fruition today. It was part of this Consolidated Appropriations Act in 2021. Just passed recently, obviously in December of 2020. That went into effect, though, as of January. So all carriers have to recalculate or recalibrate their products to take advantage of this impact of the 7702 guidelines. In short, what it does is allows the client to stuff more money in per death benefit, so it reduced the TAMRA and MEC limits. So we have that going for us as well, which I mentioned the minimum non-MEC type scenario, but also we have that effect on older age death benefit, where you can put more money in and the policy will last longer, or premium finance design, some advanced planning topics we're going to discuss, and loan rescue. We've seen a ton of loan rescue case design as a result of this concept. So as we go forward, let's look at just a quick case study and kind of some benchmarking from 7702 of what really overnight what happened whenever Symetra was the first carrier to come out with their 7702 calculations. So we were kind of in the middle of the pack on this type of design when you do an accumulation product and solve for an income distribution. Let's just take that income distribution button here where we spreadsheeted and we were, middle to the bottom of the pack at 78,000 of income coming in per year. Day one, when we flipped the switch on 7702, we went from middle of the pack or worse up to number one with an income solve. I mean, it's huge. It's a big difference to your clients of what amount of money they can put in per the death benefit. So this went from 78,000 a year income all the way up to about 130,000 a year of income solved. So that's the pure message of the 7702 when you're looking at the minimum non-MEC, maximum funding scenario, and income distribution solve. So we went it as a transparent route to say, what's the impact to the client? We didn't change COIs. We didn't pull any other levers other than the 7702 guidelines calculation. So we felt we were transparent in that aspect.
And Brad, if you can go back just one slide, one glaring number is the initial death benefit. Everyone else is in the $3 to $2 million, high $2 million range for the death benefit. After the 7702 change, Symetra, you guys are only requiring about 1.8 million for the same amount of money to make it non-MEC. So what that translates is we have lesser charges, we have fewer charges inside the life insurance contract, which translates into higher cash accumulation and ultimately higher tax-free income for the client. Is that correct?
Exactly. Yep, exactly. So you can look at it kind of two different ways. Either what's the minimum death benefit I can put in to reduce those costs, or what's the maximum amount of money I can put in. Same scenario applies either way, is you could put more money in or take more money out as well per the death benefit. So exactly what you said, Andrew, reducing costs and having more money go to work for the client to build that tax-deferred growth and tax advantage income on the way out. So that's really the minimum non-MEC scenario. Same goes here. That the last one was a male. This one is a female, age 50. Same scenario, maximum funding. We went from down at the bottom all the way to the number one scenario just because of that aspect. All right, kick it to the next one, Mr. Straub. Do you see a theme here? So anyway, same theme. This is on a little bit older, 55 preferred, pay the retirement. Using the same type of scenario, we went from 53,000 of income solved all the way up to 61,000 or 60,800 and change, just by the ability to have that lower death benefit because of the 7702 calculation. Now, we were the first, so as full disclosure, obviously folks are going to come in line. Other carriers are, have to, by the end of the year, have these 7702 guidelines calculated. But it would be interesting to see as other carriers come to the mix of what changes are going to happen, whether they're going to change, structures or loads or COIs, or it's going to be transparent to like we did with the all the benefit going to the client. So anyway, it just is what it is, and we'll just see how the shoe drops whenever all the carriers revamp the product lines. So
the other thing I was just going to hop in when Andrew mentioned
Sure.
charges in the contract. When I came here to Symetra about a year ago, I was kind of shocked when I started running ledgers, because our ledgers actually populate with the charges page in them. A lot of other carriers, it's another additional report you need to add. And you see us present a consistent theme will be the low charge structure and the low cost structure of Symetra products. So in addition to being able to reduce the death benefit, the fact that we build our products with low charge structures, it really does help the cash accumulation value.
Perfect.
Well said. And is it true too that now with the lower death benefit, lower cost structure, this strategy of overfunded cash value life insurance is now not only for your young 20, 30, 40-year-olds, but also can be feasible for, let's say, somebody in their 50s, maybe even early 60s?
We have seen that now, able to use it in the older age type strategies, and especially when you're looking at short pay funding type scenarios. So this is the 55-year-old, and as you can see, you can still stuff enough money in to make the distributions work out. So we're seeing, you don't have to always pay the retirement or pay 20 or 30 years, the whole supplemental income plan scenario from a younger person standpoint. You can do a 5 or 10 pay type scenario, peel off some other asset and make it to where you want to put it in a tax deferred, tax advantaged vehicle like life insurance. So definitely seeing it more appropriate for older age categories if you can skinny the cost down and make that transition.
Great.
Symetra is also revamping products. Everybody's revamping products now with reserving requirements, different impacts of this AG49A previously to the 7702, all these actuarial changes. One thing in our new product suite that I wanted to mention real quick is we're going to come out with what's called the AI or allocation index method. What it is, it's really a more actively managed approach to your index options. So this is just going to be another index option to where we have an exclusive agreement with the Chicago Board of Options Exchange to use the VIX, which is the volatility control measure. And what we're going to do is whenever the VIX is at 16 or more, we're going to say, hey, the market, the S&P is volatile. So we're going to pop you in to the JP Morgan low volatility account. At 16 or below, we're going to say, hey, it's not as volatile. We're going to pump your money into the S&P 500. And with that strategy from a 20-year back testing method, we've seen a 1% increase every single year on the 1-year strategy versus the regular S&P 500 with the cap method, and a 3% compounded annually every single year on our 2-year strategy under this method. So just a quick teaser on that. We've applied for a patent with it. We think it's a unique strategy that will help achieve higher results and attainable results, but also be a differentiator in our product. And you're going to see a lot of other carriers come out with other methods just besides, an S&P 500 account. But be on the lookout for this coming soon from us. Little Bird told me maybe in June, July timeframe. So coming up. Some of the other methods is Rod was mentioning, hey, what's the other methods that the 7702 is having an impact on? So we mentioned the one that people thought, the supplemental income plan type design. our minimum non-mech design, but also we have seen a ton of work and a ton of case design on loan rescue. So the reason being is because prior to this, some folks would have a loan with a cash surrender value with a big loan on it. And you couldn't bring over the loan without causing the mech because you'd have to have a higher death benefit to where the policy would make it. So basically, we want to avoid a taxable event on this. Obviously, our loan rescue doesn't work. So with 7702, you can bring over a 1035 exchange with a loan, have a lower death benefit that could last to 100 or 120, push corridor late in life, and have something that will last forever, as opposed to, we'll see in a moment what used to happen, but as opposed to perhaps having the mech rules tied to a higher death benefit that would lapse around 90 instead of making it forever to 120. So just kind of to make this sample, I know it's kind of hard to see, but this was a case design we actually ran. The 1035 exchange was about 267,000. There was about $160,000 loan. So the traditional way of doing a loan rescue is we bring the loan over, the whole 1035 loan included, pay that off as soon as we can, like year 2 or 3. We were actually able to pay this off in year 2. So wipe the loan off the books, no taxable event, and had enough cost basis in the contract, keep 220,000 death benefit forever, push corridor late in life to where 93, 97, you're bumping it up to about 300,000 in death benefit. So that's all because we can start out with that lower non-mech death benefit amount of 220,000 and keep a policy on the books forever. Now, so you look in your client books, and maybe who is a good client for this is, the old policy review, who has a Northwestern Mutual policy or an old whole life contract that has a 6 or 8% loan rate on it. You could bring it over, save a ton of money on the loan rate, as well as wash the loan off the books and avoid a tax consequence. So this is big right now. We're seeing a lot of case design work with loan rescue. So that's a traditional loan rescue, paying off the loan. We have another route where we actually ran a scenario. I think Matt's going to take you through this next sample. It's a little different, but it's an interesting idea of keeping a loan on the books. Matt, go ahead and see what was this other example we ran.
Sure, and just kind of just to backtrack a little bit, the nice thing about this is we were able to get the loan off using internal policy cash values, so it wasn't any out-of-pocket cost to the client. And then in this protection IUL product, we're maintaining a death benefit guarantee on here as well. The other nice thing about moving those type of contracts to an IUL, if we use a guideline premium test, we also offer an overloan protection rider. So if you're not able or not wanting to pay the loan off out of the gate, having that overloan protection rider is kind of a protection for the policy later years could be a good thing. It could possibly keep the client from experiencing a phantom income type play. So as you're doing policy reviews, it looks really good. Actually, this was a case that I worked with on another carrier where that's part of that. Okay, so this is a scenario that actually came over pre and post 7702 using our products. This is the pre 7702. And just to kind of illustrate the effect of having a lower death benefit has, I'm not saying that this would always work in every scenario, but this is pretty astounding. We took the same 267 over with the $156,000 loan. The initial death benefit we had to buy before 7702 was $514,000, 828. Just to stress test that, obviously it's on an IUL, so you would assume it would get a higher rate of return. We ran it at a 0% rate of return. The policy then ran out and lapsed prior, right around mortality, maybe a little bit before the person's assumed mortality at a preferred risk. Now, post 7702, you can see our initial death benefit is that much lower, $288. In this scenario, because of the lower death benefit we had to purchase at the 0 rate of return, even though it doesn't look pretty, and really all we're doing is showing you the effect of the lower death benefit and how powerful this product can be as far as taking over loans. the ledger actually runs all the way to the end of our ledger here. So even at a 0 rate of return, bringing over the loan and maintaining the loan on the product, we were able to have a death benefit all the way through the end of the policy. So like Rod said when he was looking for different scenarios where 7702 is helping, this is a protection design and it worked really well. We're also seeing in kind of pay up or protection designs where you wanted to short pay at like a 4 pay or a 5 pay, in those scenarios where those would have been modified endowment contracts. Now in some of those scenarios you can get the money in and avoid MEC status, just because much like you can buy a lower death benefit, as Brad had mentioned, you can increase the amount of premium that you would pay into the contract. So that looks really good too, as far as when you're doing protection sales and trying to short pay products.
That's pretty astounding, Matt. And for some of you that maybe are looking for a GUL alternative, oftentimes maybe the misconception is that if the product builds cash value, therefore it has to be expensive. We all seen what has happened to GUL market, guaranteed no lapse universal life market. Carriers either completely discontinue the products because of the low interest rate environment, or they had to increase the premium. And Symetra's protection IUL product, especially now with these new 7702 rates, is one of them, is probably one of my favorite universal life products, but it competes probably better than a GUL premium, and you have an added benefit of cash accumulation, and you have an added benefit of built-in chronic illness rider that you can accelerate in cash, and guarantees all kinds of flexibility that GUL would not provide. So if you have questions, if you're looking for a GUL alternative, by all means, feel free to reach out to me or George, and we'll help you with that.
Hey, thanks, Andrew, for that. Matt, can you go back to the one slide that at the 4.9 rate, and we can illustrate exactly how it has a guarantee like a GUL. So as a good GUL alternative, I don't know if you can make it bigger, Matt, but if not, no big deal. But as you can see, this product had a guarantee to 91, no matter what happens, 0% guaranteed worst charges from day one. So it's a good GUL alternative to life expectancy or beyond. And then obviously making 4.9% or AG 49 rate, it lasted forever, pushed corridor, had a couple $100,000 of cash surrender value in there. So anyway, as you can see, don't worry about making it bigger, Matt. That looks good. so to drive home Andrew's point about a GUL alternative, that's how our product would work. Moving on to advanced sales solutions. So like I said, we have our advanced planning director, Doug Bowden, with us. We have a ton of different strategies, and I think maybe as a follow-up, Matt can send you Andrew and Rod and George our advanced planning microsite link that you can tool around and have all kinds of good information. But what I wanted to point out is we have all these ideas and that have worked forever, but a couple really good ones that we're using a lot now. There's premium finance, there's supplemental income plan, leveraging alternative assets, life insurance as an asset class, which is I call the IRR story on steroids. We have a couple of these samples.
Matt, let me just kind of zip through some of the guidelines here, and then we can pass it back or open it up for questions. So our program, we've all been doing this for a long time, and the goal is we don't want to be difficult to work with, okay? But we want to be transparent and open of what would make a case that would be a good fit with Symetra. So as long as they're, age 70 or younger, net worth of 5 million, and minimum annual income of 200,000, right? That gets them in the game for premium financing. Highly encourage you. Always talk to Brad, talk to Matt, talk to myself about a potential case to make sure it's a fit, because don't get caught up in the fact that the minimum annual income is 200,000. Because if somebody's borrowing $1 million of premium a year and they're making $200,000 a year, that's probably not going to be a good fit. within there. These are qualifications that makes a case, it's got legs, we can work with it, let's see what we can do. We don't have a minimum face amount requirement because lenders are in the business to lend X amount of dollars. They're not necessarily going to lend small amounts, although a few lenders will, but most of them are looking for larger loans in there, and therefore we don't have really a minimum premium requirement or a minimum face requirement. It's really going to come down to expectations of where's the arbitrage. If you're borrowing small amounts and it's a big interest rate or a big spread in there, as opposed to a larger loan with smaller spreads in there, driving that face amount. Everything else is pretty much the same, nothing crazy. Obviously, we're going to look at financial reviews of 2 years of tax returns, a personal financial statement, or our financial supplement for that. And when we get into the design guidelines, I mean, this speaks for itself because most of the lenders out there are basically doing the same thing. So, minimum loan commitment period of 3 years. Why do we have that? Because we have to. Most of the loans out there are 5 years for a term in there. Some might be 3, some might be 7, some might be 10 that are out there. We love to see loan interest paid annually. Seems to make sense. So we're not accruing too much interest and then getting it underwater within there. And when you submit a case to us, we're just looking for a little stress testing, some increasing interest rates, just to show that it makes sense. It has a good possible outcome in there. And of course, as with all lenders, they're looking for 100% collateralization at all times. And exit strategy is key. Does it make sense? Are we only counting on policy cash surrender values? Does the client have additional assets there? That makes sense that if the policy doesn't quite perform, it can be made up. Maybe they're selling a business at a point in time and not using policy values. That's fine. We just need to understand it, and we'll work with you to make sure that the exit strategy is well understood as it goes through the review process. So anyway, I'm just going to pause. I've been going, and I can keep going for a while, but I'm just going to pause, see if any questions, anything. Brad, Matt, Rod, anybody want to add anything?
Yeah, this is Andrew, Doug. Thanks again for this overview. That's great. This is obviously not for everybody, but for your wealthier clients, again, we have some minimums that we need to keep in mind. Every news channel you turn on right now, all you hear about is, taxes going up here, taxes going up there. So think about, again, clients with high net worth who right now may not be exposed to federal estate tax issues. However, there's talk that it can come back from 20 million per couples to maybe 5 million, or maybe even lower. There's also talk about capital gains taxes maybe doubling. So if clients are, invested in different stocks and they have to liquidate that and pay capital gains taxes, they may not want to liquidate that and pay the premium. So this is where going and financing the premium to pay for life insurance could make a lot of sense. And you're just paying interest out of pocket. You don't have to liquidate those investments, pay capital gains taxes or owner income taxes, that could be much higher. Let's finance the premium. Let's get your local, bank institution, do a letter of credit, and we'll just pay the interest out of pocket, and works beautiful for the right kind of client. And I would be interested to see, do you guys see most of the premium finance for estate and legacy planning situations, or are there designs where we're using that for supplemental tax-free income down the road?
Andrew, it's about a 50-50. It really is. Right. Obviously larger cases are for wealth transfer estate planning, but it would not be uncommon for us to see a wealthy individual that certainly meets our guidelines and has the financial substance to do a premium financing arrangement, to do smaller premiums with minimum non-MEC face amounts, maybe $150,000, $200,000 a year. And then once the loan is repaid, and then basically they're they're creating their supplemental income plan with it, if you will, but they've got some death benefit in those early years. So for wealthy clients, it certainly makes sense with the with the leverage of those loan rates today. How can you say no? 2.85% borrow against it.
Absolutely.
I would say one
Absolutely.
thing too, it works for the high net worth individual, obviously, but also someone who's used to leverage, like a real estate developer or someone like that. We see a lot of that in this sort of client profile. Also, for the supplemental income plan design, we can go down in age a little bit here, save and down in net worth a little bit for the younger, like a young doc who's doing really well. Maybe they're making 500, 750 grand a year. We have some income history there. Maybe we can go down a little bit in net worth for a younger person who would do that supplemental income plan scenario for like a young doc or a young business owner that has a few good years of track record. So keep that in mind on that supplemental income plan design. But and also on the older age wealth transfer folks, it is a lot with, as Andrew said, someone who doesn't want to liquidate a portfolio, or to take that a step further, the real estate person or the car dealership owner. A lot of those folks that are used to leverage, this seems to speak pretty well to those type of individuals. So.
Hey guys, I have a question. Are you intending to come out with a second to die policy? And if so, when? And if so, would it also be eligible for premium finance?
I think the answer is yes, we will come out probably with a survivorship product. I can't tell you when. It's not going to be this year. And the big question is will it be an index survivorship product as opposed to a variable, right? We just haven't got that far yet.
Okay, thank you.
It's on the docket though, right, Doug? It's on the docket.
It is. Did I give away too much information?
No, not at all. Not at all. Well, definitely appreciate it. I know Andrew's with the chat can take some questions as we go along. I think we can push forward a little bit to get through a couple other strategies, and then maybe open it up for a couple chat questions or a couple questions while we have everyone online, if that's okay. One thing to mention too is, I think maybe an appropriate time, we have $1 million premium limit, temporary, but we could pay $1 million every single year into a policy, as long as that policy wasn't over $20 million death benefit. So we have a $20 million death benefit limit and $1 million per year premium limit. Also on the PDA account, currently we have a $3 million cap on that. So I've actually won a couple recent cases because the client had money in a trust, put it into the PDA account, funneled that in to create a non-MEC, right? And we're one of the only carriers that could take $3 million into a PDA account. So we can capture a lot of big cases with $3 million PDA and $1 million every single year into a life policy and $20 million death benefit. So I think we'll take those all day, every day, right, Andrew?
Absolutely. And PDA, again, for those of you, premium deposit account. So if you have, again, somebody sold the business, maybe inherited the money, they do have, $100,000, $250,000. We can't do single pay because it will make the contract, but we can move it into that PDA, premium deposit account, pays 2% interest, and then from there it automatically funds properly designed life insurance plan that would build cash value and provide tax-free income down the road. So it just takes the complexity out of the deal. You don't have to resell the contract every year and then ask for that $50,000 a year premium. You just write the check one time and then it's done.
Yeah, and a benefit to the 7702 calculations is we can get that money in usually sooner. So like a 5-pay type scenario when a lot of other carriers may have to be a 7-pay type. So that's one thing too. And also kind of to bring it to this discussion as well, the premium finance scenario with a 7702 works just like that minimum non-max. We can put more money in, get roll out of the loan earlier. I call it the good guy premium finance scenario because we're withdrawing. I mean, we're not taking these par loans, solving the world's hunger issues with a par loan on your life insurance policy. So we're taking withdrawal, good guy, out of the loan, get it out earlier because we can stuff more money in due to 7702. So that's one reason as well that we're working a lot on those premium finance designs now too. So
wonderful.
All right, so supplemental income plan. We talked about this too. You know, in some of the benchmarking, it's really what we were doing there is a supplemental income plan, minimum non-max, maximum cash value income play. Here's just a Jim, male age 45. Man, do I look that old? I'm 45, for Pete's sake, Jim. All right, so male age 45, looking off his boat. He's looking for a retirement income. Next page, please. So this is part of the supplemental ledger, just like we have supplemental ledgers that match right up to the NAIC ledger. In our software, we have these for this supplemental income plan type design where it has these pretty charts and graphs that shows Jim really what's going on here is paying a premium to the life insurance policy. If he dies, obviously the beneficiaries get the death benefit, but also he's doing it in a dual solution type scenario where he has access to the cash in a tax advantage scenario via withdrawals or loans. Next page, please. In our supplemental income plan ledger, the supplemental ledger, we have a nice summary page, and in the sake of time, I kind of wanted to keep it brief on this, but we have a summary detail of the case design here to where you can really outline the power of the tax-deferred growth and tax advantage income. So what we have here is a snapshot that you can put right up to the ledger and customize it to this particular client. They have, in this instance, about $610,000 at age 65. They're taking policy value distributions for a supplemental income. So it kind of lines that all up. But the big power in this is the pre-tax equivalent. So if they took out $48,000 a year from any other type of investment, obviously they'd have to pay taxes on it depending on what type of investment that's in, an IRA account or capital gains taxes. As we've talked about, tax rates are going up. A pre-tax equivalent distribution from one of those accounts would have to be $71,000 a year to equal the $48,000 a year coming out of life insurance. So that's really the power, in my opinion, of this tax strategy. And then the IRR on death benefit at age 85 is still 5.58%. So you're only losing, the way I look at it, 0.4% to have this in the life insurance wrapper because we made 6% a year on this in your indexing accounts.
Amazing. That's amazing.
Isn't that crazy? With all the tax benefits of the tax deferred growth and the tax-free withdrawals and then tax advantage loans to create this supplemental income plan. So that's a nice one pager you can show your client that's customizable to them. All right, that's it for supplemental income plan. Go ahead, Andrew. I'm sorry.
That's great, and obviously, you know, most of the people have their retirement income assets in qualified accounts, IRAs, 401ks, 403bs, thrift funds, whatever. 100% taxable when that comes out, and chances are taxes are going up, not going down. So yeah, you might be grossing, $100,000, but after tax, your client might be netting only, 80, 75, 70%. So consider maybe doing a bucket strategy where, the client has qualified accounts, everything is going to be taxable in retirement, doesn't have a Roth IRA, making maybe too much money to qualify for a Roth IRA. Well, cash value life insurance properly designed, especially post the 7702 rates, is a perfect Roth IRA alternative. And now you can pull some money from your retirement accounts at 100% taxable, and then some money from tax-free bucket, i.e. life insurance, to net maybe 90% of the total income that's coming out for the client.
It's always good to have different buckets of money depending on what the tax rates are, and you can pull appropriately from each of those. So that's a good point.
Absolutely.
For sure, Andrew. Yeah.
Well, gentlemen,
I guess in the sake of time.
Mm-hmm.
Yeah, go ahead, Andrew.
I was going to say, just a time check, we're about 2 minutes. we're 2 minutes to an hour here.
Yeah, the other strategy was really life insurance as an asset class, and what it does is it takes your particular situation and the client says, well, I could do better with my other assets. So we have a module that compares your other assets growing versus the leverage in the life insurance, and really all it is this IRR story. I call it the IRR story on steroids, and that's what we call, life insurance as an asset class or leveraging alternative assets, to where we can compare that IRR to other investments or other assets. So it's really, as you can see, when you're talking about all these strategies, the tax play is huge, and if you get a good IRR or internal rate of return on the client's money, it's hard to beat it when you factor in the taxes. So that's kind of me and what I was wanting to say as a wrap up. But Andrew, if you have any questions on the line or anything in the chat, we could probably take those for a couple minutes.
Yeah, let me unmute everybody. So if somebody has questions, please go ahead, unmute yourself.
Not all at once.
Everyone is shy. All right. Well, with that, I think it's a good time to wrap up. Want to again say a big thank you to our partners at Symetra, Brad, Matt, Doug. Great stuff as always. Great products, great culture, and we're certainly looking forward to continue working with you. And I appreciate everyone else's time for joining us. Myself, George Steele, will be reaching out with some materials after this webinar to answer any questions that you may have, or maybe you have some cases that we can illustrate and design using some of these opportunities that Brad discussed. So look forward to that. And again, thanks everyone for your time, and have a great rest of the week.